Well, today's move in financials comes ahead of the kickoff of bank earnings season. RBC Capital Markets top bank analyst sees today's weakness as a buying opportunity. Gerard, Cassidy is the firm's global financials research co-head. He is rated 4.98 stars out of 5 by Tip Ranks. That's quite high, Gerard. Congratulations. I mean, I don't know where the .02 went, but, that's what my dad would have asked me. In terms of the move that we...
Guy must have voted for me, so thank you.
In terms of the move today, how do you view this credit card rate cap proposal and the impact on some of the larger banks that have credit card portfolios?
I think you guys have discussed it well, and Karen pointed out about the legislative part of this. The executive order is not going to force any of the banks to lower their rates to 10%. It either has to come legislatively, like the 2009 Credit Card Act, or it can come through the regulators where they codify some regulation. But both of those takes time, and we don't expect either of them to happen. So we think that this is a buying opportunity. We think it is done for political purposes. You guys touched on it with, the cost of living and the cost of purchasing different items, whether it's healthcare or groceries, et cetera. So this is a way of the president obviously trying to get out there and try to show folks that he's trying to help them out with the cost of living. But once again, we don't expect it to follow through. And as it is a good buying opportunity. And to your point, the commercial banks, the big banks, have some exposure, but it's the credit card companies that you guys talked about have a much greater exposure.
But this doesn't muck up the narrative of deregulation, in your view, Gerard. I mean, the administration's friendliness toward the banking industry, and that being the tailwind, a major tailwind to the bank story last year as well as this year. It doesn't change that at all. It doesn't make you a little bit concerned that maybe there's too much of that in the prices.
No, not at all, Melissa. And I'm glad you brought that up because this administration has done an incredible job of focusing in on deregulation. Treasury Secretary Besson in February of last year was very clear that they were going to loosen the corset of bank regulation around the banks, and they've done that very well. The big one to come, of course, is the Basel III endgame changes that we expect this quarter. So this actually flies in the ointment of that deregulation trend, but we do not see that changing. And especially since the Treasury Secretary wasn't behind this, that would have given me more concern if he came out and said something like this. But again, we think it was more for political purposes for the president.
Gerard, it's Karen. Thanks for being on. So I'm long banks, JP Morgan, Citi, bigger positions for me. Everything's going right now, right? We have deregulation and we have GDP is pretty good, credit quality is good, asset wealth management is good, capital markets is good, M&A, all of that. Does that scare you at all, that it's all so good? What could go wrong?
Karen, I'm going to take you to the racetrack. You read my mind. What I really worry about is there's nothing to worry about. That's the worry. And so to us, you said it well, and I would say that, the steepening yield curve, we've been pointing out to investors, it's been 20 years that the Fed funds rate's been at around 3% with a positive slope of 75 to 100 basis points. If we get that environment for an extended period of time, lenders, net interest income will grow very nicely. And I don't know if you guys have been watching the loan reports on Friday. That's the H8 report from the Fed. At the beginning of the year, the H8 report was showing industry loan growth of 0 to 1%. Last Friday, that number was 5 to 6%. So we're going into 26 with 5 to 6% loan growth, steeper yield curve, credit is benign, deregulation is behind us, the economy is healthy. And to your point, Karen, it's looking very positive, which as bank people, you get nervous when it's that positive.
Gerard, Derek Jeter, somebody did not vote for him to get in the Hall of Fame, so he missed it by being unanimous by 1 vote. By the way, I did not vote for you. I would have. So the 498 is effectively a 5. U.S. Bancorp is the name you mentioned. I think it made its all-time high in 2022. It trades 11 times next year's numbers. You probably have 10% earnings growth. What's holding that stock back, if anything?
Yeah, it's a good question, Guy. And I think the big holdback was the sentiment on the stock was very negative coming into 25. They had a surprise change with the CEO in February. That kind of set it back. But more importantly, from a fundamental standpoint, the company has struggled with its expense growth. And this company, the hallmark of this company 5-10 years ago was this low efficiency ratio. And they lost sight of that. However, What has happened more recently is the operating leverage, that's revenue growth versus expense growth, which was negative coming into the year, has turned very positive in the third quarter and should be positive in the fourth quarter. If they put up 2 quarters in a row of strong positive operating leverage and give guidance for 26 for continued positive operating leverage, we think this could be the real winner. Because to your point, it was one of the biggest laggards last year of the regional banks.